Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day and sharing some time with us. We have another great show, as always, a lot of information to get through and share with you on with respect to what's happening in the world, the effects on your portfolio, the effects on the markets in general. Putting things in perspective is always what we try to do here on the Allan Small Financial Show. We also have a fantastic guest. Patricia Lovett-Reed will be our guest. Patty is the personal finance expert and chief financial commentator for now Home Equity Bank, and a lot of you may recognize her from being the chief financial commentator for CTV News for many years, and prior to that was over at TD Waterhouse. So great to catch up with Patty. A lot of you remember her. She's been on our show many times in the past, and we got a chance to talk about everything that has to do with the markets and investing. And we even got a chance to ask her about interest rates and taxation. So a great interview. We're going to bring that to you shortly. But let's put up what we're going to have on the show today. Our first topic, I think, is probably most important for everyone right now. Market volatility continues with no end to the Middle East conflict in sight. We're just hearing that Iran, when we're not sure if this is true or not, but reached out and said that they would like a ceasefire. But President Trump apparently has said that until they open up the strait, they're not going to be talking about a ceasefire. Not sure if that's true or not. Iran keeps denying anything that we keep hearing. And I think the president's going to be speaking tonight. State of the Union address, I guess, to the nation at 9 p.m. So very interesting to hear what he has to say. Our second segment is our interview with Patty Lovett-Reed, as I said, chief financial commentator, Home Equity Bank, formerly chief financial commentator with CTV News. Then we're going to move into our top 3 things to consider over the next 5 to 10 business days. As always, these are the top ideas that I have to share with all of you as to how you should be thinking. What should you be thinking before you make your investment decisions? Our fourth segment, impacts of Iran war starting to be felt beyond oil. Obviously, oil has, or the war has the biggest effect on oil prices, and oil prices is having the biggest effect on the stock market. But where else, or what else is impacted by the Strait of Hormuz being blocked right now? And we'll talk about other areas that are feeling it because of the strait being blocked. What happened to the Mag 7? Yes, the Mag 7, Magnificent 7, something we used to talk about on a regular basis on all our shows over the last little while. We haven't really talked about Mag 7. We've talked about big cap tech. And today we're going to talk about the group of Mag 7 or Magnificent 7 stocks, how they've been faring. And I guess the answer very quickly is not too well. Quick hits, part of the show where I talk about 3 things that I came across in the news over the past couple of weeks, share some ideas on those. And last but not least, your questions. If anybody has any questions during the course of the show with regards to Patty Lovett-Reed and our interview or anything else that I talk about on the show, please put in the chat boxes that you have, either if you're watching through YouTube or Facebook, Instagram, wherever you're watching our show. Please, you can let us know your questions. We will pick those up. And hopefully I can answer at least 1 or 2 of them by the end of the show. And if not, we will answer them on our next show. So a great lineup of information-packed segments. And so without further ado, let's move on to our first segment. Market volatility, and it continues really without an end in sight to the Middle East conflict. And for many people, we're all looking at the Middle East and thinking, okay, when that conflict comes to an end, and we all know it will come to an end at some point. No war lasts forever, although the Russia-Ukraine situation is still ongoing, and that's been around for a bunch of years now. But I think we can all agree, and probably most of us would say that the Middle East conflict will end at some point. According to the president of the United States, President Trump says the war will probably last another couple of weeks. So the volatility at some point will die down. But for now, the volatility is quite significant. we're seeing the VIX trade quite high, which is the measurement for the volatility index. And it's interesting, or it's actually coincidental. I was driving in my car, I guess a few days ago, and I had on my radio, I had on one of the news stations, and I heard some interesting statistics that an analyst, an economist actually was providing. And I found them very, very interesting. And I'm going to give you those statistics right now just to show you how volatile these markets are. And the volatility can actually explain some of the questions that some of you may have as to, why is my portfolio down as much as it is? Or why is one of my accounts higher, one of my accounts even for the year, and one of my accounts lower for the year? How can we have, three different accounts, an RSP, a TFSA, maybe a locked-in RSP, or just a regular investment account, three accounts from the same person, but yet you could see significant differences in the returns for this year? Well, our first chart can actually shed some light on that, and it is, there you have it. Interesting statistics. So 72%, a big, big number, 72% of S&P 500 companies are now trading more than 10% below their 52-week high. So 72% of S&P 500 stocks coming in. This is about a couple of days ago. Doesn't include yesterday's rally and the rally that we've seen so far this morning. But of a couple of days ago, you can see there, March 18th is when they took the data from. 72% of stocks are in correction mode. 57% of S&P 500 companies are down more than 15%, and 42% of S&P 500 companies are down more than 20% from their 52-week high. We would say they are in bear market status or bear market territory. Now, interesting enough, there are also a small percentage of companies that are actually higher by more than 20% on the year that trade on the S&P 500. Obviously, oil companies. Oil companies have been benefiting from the price in oil spiking. Chemical companies, fertilizer companies, these types of companies are benefiting from the Strait of Hormuz actually being closed, and because shipments cannot get through for fertilizer, for certain chemicals. And so we're seeing the stock prices of these companies move higher around the world. Certain tech companies still are above 20% higher. Some of them are in the memory chip space. Some of them are in chip space in general, and some other companies as well. So it's interesting. And this is a stat I heard in the last few days. If you look at the companies that are trading greater than 20% above where they started the year, and add to that the companies that are down by more than 20% from their highs on the S&P 500, there are more companies right now that are in that segment, either up more than 20% or down more than 20%, than companies that are flat or trading under a 20% loss. So you have over 50% of the S&P 500 companies trading greater than 20% to the upside, or trading down more than 20% to the downside. And that's why you're seeing the volatility that we are experiencing. If you have a small account, for example, a few $1,000s in it, and you're only able to have maybe just a handful of stock in those companies, and unfortunately you're in the camp of companies owning a few companies that are down more than 20%, well, yes, your portfolio is going to be down substantially this year. On the flip side, you could have a small account that has a couple of names in it that are in the camp of being above 20% or greater than 20% for the year, and you're going to be loving what your portfolio looks like. But it's just a matter of the size of the portfolio. Some portfolios that are quite large have a nice diversity of different companies. Those are the companies you're going to see, or those are the accounts, I should say, that are going to probably be somewhere in between. So maybe down a few percent for the year, but you're not going to see the tremendous loss or the tremendous gain, because you're probably going to have companies from both camps, companies from both groupings. And so I guess that's a pretty good, selling point for diversification. All portfolios need to be diversified. And this year clearly proves that if you are diversified, you're probably faring a lot better. And that's also why you're seeing the S&P 500 up until yesterday down 7% for the year, when, as I said, so many companies trading lower or off by more than 20% from their highs. And as I said, 72% of S&P 500 companies down by more than 10%, yet the S&P 500, at the worst that I've seen it so far, only down 7%. And that's because we have these small grouping of stocks that are taking up the averages. So extreme volatility. The volatility index actually spiked. We have a chart on that shortly, but let's show a chart on the S&P 500 next. We have that as our next chart. There you have it. Look at that volatility. Look at that sell-off to the downside. And it's been consistent. We've seen little blips along the way, but you can see a clear channel to the downside. Once upon a time, the S&P 500 was at 7,000 points. Our next chart is the VIX index, the volatility index. And you can see here clearly that it has come down recently with some positive news, perhaps, coming out of the White House, that maybe the war is closer to an end than most people have thought. The VIX was trading well above 30. Now it's down to 25. So volatility, it is something that has been with us now for quite some time. It explains why certain portfolios have been flat at times, have been down at times. It explains why the overall general index, the S&P 500, could be trading only down 5 to 7%, whereas many more of us are feeling a lot worse because there are a lot more companies that are trading below 20% or off by more than 20% from their highs. So even though the overall index is not showing the decline that many of us are actually feeling in our portfolios, the volatility is still there. And I just wanted to explain to all of you how the volatility works and why it's so prevalent. And no, these are not normal conditions. We normally do not see such a high percentage of stocks trading up by more than 20 or down by more than 20 in a given year. So understand that the volatility is here, definitely not here to stay. Things will come down, but we definitely need some resolution to the conflict in the Middle East to start to feel that the indices are starting to calm a little bit. So with that, I want to get on to our next segment, which is our fantastic interview with Patricia Lovett-Reed. She's going to talk to us everything about markets, what's going on in the Middle East, and how it's affecting your portfolios. I'd like to welcome back Patty Lovett-Reed, personal finance expert and chief financial commentator with Home Equity Bank, to our show. Patty is known for providing tips on how people can save money and stretch their incomes. Many of you will recognize Patty from her days as a former chief financial commentator for CTV News, and she also served as senior vice president at TD Waterhouse Canada. Welcome back to our show, Patty. So great to have you.
Oh, thank you, Allan. It's in different times, but I always enjoy our conversations.
Yes, and I as well. And it's great to have you back on, especially, like you said, during these different times, volatile times, to say the least. I thought we would start off, talking, just ask you a general question, but I wanted to read you some statistics and get
Okay.
your input or how you feel about them. So 72% of stocks on the S&P 500 are down more than 10% right now. 57% of stocks on the S&P 500 are down more than 15%, and 42% of stocks are down more than 20%. Interesting enough, there are more stocks down or up 20% than less than 20%. It is definitely a very volatile time. So you have stocks going up and down all over the place, and obviously investors are asking a lot of questions. Canadians are certainly noticing increased prices at the gasoline stations, at the pumps, and obviously that's pretty much affecting most aspects of the economy, as well our economy, as well as the global economy. So with all those statistics, and as you know, everything affecting the economy right now, from going on, war in the Middle East, with everything that is happening, how do you feel the markets are faring right now? Do you think they're hanging in pretty well, or do you anticipate things to get a lot worse in the near future?
Well, thank you for starting with such an easy question. What I will say is, there, in my mind, at this point, there's no question that this is a market that is under pressure, but it's not a market that's broken. at least not in my mind. What you often see is during periods of volatility, it comes from any sort of risk. We've been through risk before. Geopolitical risk is a very serious one. It doesn't mean that it's often long lasting. It may take time for the markets to adjust, but I do think they go through an adjustment period. And that's the period that we're going through right now. So if I think about it, yeah, they're not broken. And when you're in the markets, there are going to be periods of volatility. And this is definitely a period of volatility that we're going through.
So orderly, I guess I've heard that comment made,
Yeah.
when markets are declining, I've heard people say it's an orderly decline. I know for investors it probably doesn't feel any better, but for us in the business here for so many years, you can see something orderly or something chaotic, and obviously orderly is a lot better. And you and I have seen a lot of conflicts, geopolitical conflicts in our
Right.
careers, while
Mhm.
managing money and commentating as you have.
Yeah.
What do you think investors should be considering right now? What should they be doing during this time of volatility? How should they be approaching their investment portfolios?
I don't think you want to be naive. I think you do want to look at your investment portfolio. And I know you're an advisor. And if I'm your client, I want to hear from you. And I want to hear from you more frequently than I might under periods of, somewhat, shall we say, a little more period of stability. But at this point, the last thing you want to do is let your emotions dictate your investment decisions. If you're overweight in a particular sector, there's nothing wrong with rebalancing to ensure that your tolerance for risk is still aligned. But I also think that the time horizon when you're in the markets at any given point, I've always thought, okay, I need to be in these markets for at least a 5-year period with where I'm sitting today. And so that would argue that you do need that longer term perspective. So in the moment, the conflict is driving the volatility and it can be gut wrenching. And if your portfolio is down, and to be perfectly honest, ours is down and quite significantly. That was one day. The next day, it did bounce back. It's like it's been the analogy that's been used out there. It's like that in my case, that bad boyfriend. Like, he just isn't always there for you. And then he shows up, and then you think all is right, and then he's gone again. So, I think right now you do want to say to yourself, okay, let's look at where we stand. Let's look at our asset allocation. How well diversified are we? Are we investing in leaders in their industry? Good quality investments, companies that pay a dividend, increase their dividend, and pay you to wait to get through this. Not everything's going to go up. It's a challenge, that's for sure. But this isn't the moment that I'm making wholesale changes in my portfolio.
I guess going back to your TD days, would you be wearing your buyer's hat at this point, trying to take advantage of perhaps some of the good quality names that are on sale?
You know what? I am always a buyer and have been, and I have been in this business. I love how I was introduced not long ago for decades and decades and decades. And then they said decades. I mean, you can drop one of the decades, but I have been around a long time. And when buying opportunities present themselves, I'm not saying you bet the farm, and I don't think you should be invested in one country, one company, one asset class, one currency. I do think if there's a buying opportunity and you've had your eye on something for a while, I guarantee you institutional investors are sniffing around. And what happens is sometimes the retail investor's the last one to capitulate, to throw the towel in. And then when they decide to buy, finally, they're the last one to buy in. And that's a tough way to make money. So I do firmly believe that you have your eye on a particular prize. You understand what you're prepared to pay for it. It may not be the bottom, but if it's a longer term hold, then it could be a great buying opportunity. Is that how you look at it? I mean,
That is how I look at it, most definitely. I think
yeah.
times like this are really opportunistic. I think history tells us that markets do rebound quite quickly
Hmm.
after a war or a conflict. History tells us that time and time again. And
Yeah.
so, yeah, you hate to want to take advantage of the current situation, but as an investor, these are the times you can buy things that are good quality and quite cheap. So definitely, most definitely. And actually, that takes me to my next question. And
Hmm.
a lot of investors lately, I actually been getting some phone calls on this, and they're saying, you know what, Alan, even if the war ends, the conflict ends in the Middle East in the short term, really soon, it's
Yeah.
going to take a long, long time to get natural gas back online, to get
Yeah.
the oil going through the
Yeah.
strait again, and for everything to get back to the way it was prior to the conflict. Do you think the situation, for the markets is like that in terms of, do you think things are going to take a long time to get back on track, even if we do see some sort of end to this conflict, one way or the other, in let's say the coming days or weeks? Do you
Yeah.
think investors are going to have to wait a long time to see things get back to more normalized state?
I do think if we saw some resolution, there would be a bump in the market. But here's the thing, you have to be in the market to take advantage of it. The markets aren't going to wave a white flag and say, okay, by the way, now is the time that you should have been invested, because they will move before or in anticipation of what you're talking about. But let's say we get a de-escalation. I'm not really in the camp that the markets snap back, not as quickly or as thoroughly as we would like. I do think sometimes it takes time and it takes patience. When you talk about the strait and the supply chain and the challenges that will be there when things start flowing again, that can't happen overnight. Those bottlenecks are there and they will continue to impact throughout the entire system and the flow through, so to speak. So I think it'll be gradual, and I think it's a good reminder that we talk about it, because this is where, and I don't always have this virtue, but patience is a virtue, and we have to allow the time that's going to be required, because the backup is huge.
Thought we would, and I agree. I think that it may take a little while, but I think you will get that initial bump up in the markets,
Yeah, I do.
some relief, I guess, initially, and then maybe a bit of a flattening period until, we see what comes next. So definitely waiting for that. But as we know, there were some issues in the economy prior to, some issues with the markets prior
Mhm.
to the conflict, whether it was AI disruption, whether it was, trade, the Fed, a lot of those things we were grappling with before the war. So perhaps we shift back to those things and see how the market tackles those that
Yeah,
situation.
because they have not gone away. And in fact,
Absolutely.
we've heard from our Deputy Bank of Canada governor, and I'm assuming then the Bank of Canada as a whole, that when they look at the challenges for our growth perspective, and this isn't long term, it's even shorter term. We're dealing with the geopolitical risk with trade. We're dealing with immigration issues. We're dealing with AI, and all of those are going to impact on Canada in terms of where we're at right now.
Yeah, and we are definitely seeing a slowing or a slow economy in terms of growth, in terms of a lot of things. And again, another great intro. See, another intro to my next question here, and which is I have an interview with Jack Mintz coming up, and he's a tax expert,
Hmm.
uh, and coming up on our next show, and we're going to be talking a lot about interest rates, taxes, and obviously the economy. And as we've just said, the economy is unfortunately not firing on all cylinders, to say the least, at this point in time. But I'm curious to hear what you think about interest rates in our country at this time. Do you think that the Bank of Canada is doing what they should be doing with interest rates? Do you think our country needs to look at our tax system and perhaps think about revamping it to spur on more growth?
Wow, you know what? Jack Mintz is one of the best in the business, and I hate to try to preempt him, because I will be listening to that interview. But just on a personal note, the Bank of Canada rate is at 2.25%. I'm sort of in the camp that the Bank of Canada has done what they can to get us to where we are. Will they go lower? I really don't know. The next move higher, I think it's a wait and see because we have to see the flow through the higher oil prices and what that does to inflation. So they're not going to try to preempt themselves to cut or even, prematurely to turn around and have to raise interest rates again very quickly. And, that's a challenge for a lot of Canadians because when you look at the number of mortgages that are resetting, in the 2026, 2027, it's huge. And the Bank of Canada is very aware of that. And the sticker shock alone will take disposable discretionary spending out of the system. And we are a consumer-driven environment. But I think you raise a really great point as well, when you look at our tax situation. I've often thought when I think about, what would make things really attractive to invest here? Well, in order to get business investment, we need businesses to invest. We need to have innovation. When I cross things off, I'm thinking in my own mind, capital has to stay here in Canada. And so Canada in the past has proven, I think, to be very resilient, but I think we are going through a shift in terms of reinvention. It's like the power of the pivot. This started possibly with tariffs, at least in my mind. But I do think taxes, regulatory environment, productivity, all of this matters if we are going to be a magnet for capital here.
I agree. And, talking to the Premier Ford, he talks a lot about having more money in the hands of businesses or the hands of the
Yeah.
people. And I agree with that. And I know Jack, mentioning Jack again, he coming on our show, he's going to talk about his plan for tax reform that we haven't really looked at tax reform in many years. And so I'm a big proponent of that. I think to be competitive with our neighbors to the south now, which is extremely important, with their one big beautiful bill or whatever you want to call it, their tax rates are
Yeah.
lower. They
Yeah.
are trying to have more money in the hands of businesses, bring in more business, and it's
Mhm.
going to be, it's something that I'm concerned with because I think our tax system as it stands right now is not as competitive or is no longer as competitive as the United States, for example. And so why would business come here versus there? And that's my worry.
But I do think it's beyond just the tax situation.
Oh yeah, oh yeah.
We have to encourage innovation. Our regulatory environment has to welcome it, and we have to be seen as a place, a country of stability for people to want to invest here.
Absolutely, absolutely. I thought we'd end off our interview again, shifting gears a little bit. The last time you and I spoke on the show here, on my show, um, since then, actually, two sectors really have taken off. And one of them is
Yes.
technology
Yeah.
and obviously artificial intelligence, and the other is gold, materials, gold in
Mhm.
particular.
Top performing sector, I believe. Yeah.
Yeah, and I guess lately it's been oil, but prior to that, it was definitely gold and AI and everything about those two things. Wanted to get your take on those two areas, and you could split them up or deal with them together. What do you think? Should
Yeah.
investors continue to invest in tech, in AI, in AI spend? And what do you think about gold? I'm not a gold bug. I have to say that. A lot of people that
Yeah.
know me.
I haven't
I'm a
got
bull on the US dollar, US economy, and so that makes it more difficult for me to buy a hedge against US dollar strength, which is gold. So, what do you think about these two areas? Do you think they can continue to rise together simultaneously? Do you think that maybe we've seen peak spend in technology and we'll start to see a bit of a pullback there? What are your comments when investors come to you and say, should I be buying gold or tech, or should I be buying other sectors?
Oh, wow. Okay, so I mean, they're two different asset classes. They're two different not asset classes necessarily, but sectors for sure. I mean, if I have gold in my portfolio, I'm doing it more or less for protection. And if I have technology, I'm looking for growth. And I can tell you that I don't think we have very much gold in, but we do have technology. And do I think that's hit a peak? No, I absolutely don't. But that's not the entire portfolio. So once again, I think when I think about, should investors have these in their portfolio? Sure, if it fits with who you are as an investor and your longer term perspective, your tolerance for risk, those sorts of things. So diversification still matters, no question about it. I don't think we should be chasing performance, not in this market. Quite frankly, not in any market. And, being responsibly weighted in these particular sectors probably makes sense, but it has to make sense whether or not you're a gold bug and you're fearful and you want that protection. But I think the one that I can say definitively, and I'd love your perspective on it, is no, I don't think technology is done, AI specifically. I still think we're in our infancy.
Yeah, I agree. I agree. And I think, so at times it can be a little misleading. You look at some of the big cap tech names like an NVIDIA, for example, the biggest
Mhm. Yeah.
in the world today, biggest company in the world. And you've seen their stock performance. It's been pretty flat for the last, let's call it 10 to 12 months. Stock can't seem to gain any traction. In fact, the better they seem to be doing, the more the stock actually sells off, with their $1 trillion backlog of business that they announced not that long ago. The stock fell that day. And it just outstanding numbers, just massive numbers. So I'm in agreement with you. I think it's just a matter of, are these companies priced for perfection at this point in time?
Some
And
are.
and what's it going to take for it to, the bar is so high. What's it going to take for these companies to get to the next level? And I think that's what investors struggle with.
Well, and I think that's a reasonable struggle because quite honestly, when you talk about AI, what's the ROI on AI at this point? Investment's been heavy. I don't think it's going to go away. I don't know about you, but I use AI hourly, let alone, just on occasion. And it's changed my productivity. So I'm just an average person. Can you imagine what this does for a broader segment, for a business when used appropriately? But, how you monetize it is going to be really key going forward.
Yeah, no, for sure. And more smaller businesses are adding more and more AI functions to their everyday business. There's no doubt about that. Statistics that we had recently shows that. So AI is the future, and hopefully the jobs hang in. Hopefully,
We'll
you know,
see.
we can produce new jobs of the future. But
Yeah.
Patty, I want to thank you. That's Patty Levitt-Reed, personal finance expert and chief financial commentator with Home Equity Bank, to our show. As always, it's a pleasure having you and getting your perspective on the markets. I want to thank you again, taking some time out of your busy schedule.
Thanks a lot, Alan.
All the best, and we'll talk soon.
You bet.
Okay, bye bye. Just a great interview with Patricia Levitt-Reed. It's always great having Patty on. She's been a great investor for so many years and a lot of experience in navigating what we're seeing today, conflicts and crises, and obviously, talking to us about trying to take advantage, buying things, good quality ideas, staying diversified. Many of the things that we talk about on this show, every show that we have. And that we bring to you. So once again, thank you to Patricia Levitt-Reed. Now we come to the part of the show where I talk about three things that I think individual investors need to be focused on at this point in time when you're building out your portfolios. Number one, as goes the price of oil, goes the markets. Pretty self-explanatory. It's kind of a indirect or as the oil prices rise, stock market falls. As the oil prices come down, stock market seems to rise. So kind of go in opposite direction. Investing during uncertainty. Now, this is more of a strategy, and I liken this approach to almost like playing a game of chess. I'll explain what I mean by that in a few moments. Important economic data. We're actually going to get some real important economic data starting off or kicking off this Friday. Some of you are wondering, yes, this Friday is Good Friday. Markets are closed, but the US will give us their jobs numbers. They'll give us their jobs numbers for the month of March. So unfortunately, investors won't be able to act on these numbers, either buying or selling or whatnot. They'll have to wait until Monday to do that. but we're going to get some economic data. Jobs numbers out of Canada comes out the following Friday, April 10th. Next week, we're also going to get some inflation data, PCE, CPI out of the US. Very, very important. We want to know if the higher oil prices and energy costs, is it actually having a factor with respect to inflation? Is it seeping into core inflation numbers? So economic data, that is our third thing to focus on. So let's move to our first idea or topic. As goes the price of oil, goes the markets. And if anyone has been paying attention, as we've seen, Brent crude, which is the price of oil in Europe, WTI, price of oil in the United States, as we've seen those prices of oil move higher, the market tends to sell off. We're also seeing bonds in the US, yields move higher when we see oil going higher as well. Obviously, the fear for the market is that as oil prices move higher, that is not good for inflation. Costs rise. When costs rise, people stop spending. When people stop spending, obviously profitability, revenues, margins, you name it, for businesses fall. Whether you're a small business, a large business, I would think small businesses might be affected a little sooner than larger businesses, but nonetheless, as oil prices go up, the markets tend to come down. And so we've seen a lot of volatility in oil prices changing with just a quote out of the White House from the president, something said out of Iran, something said anywhere from European nations, from Asian countries. Anybody can say something about what's going on in the Middle East, and the price of oil can spike, taking down markets very, very quickly. Or we could see a reverse, where oil prices come down a few percent, and all of a sudden the market shoots higher. Our first chart that we have here is just to show you how much of a spike we've seen in oil prices. You'll have Brent crude, WTI. Brent is the pink or the line, I guess that's above WTI, which is the lower one. But nonetheless, the illustration clearly shows that we've seen a spike in oil prices, global oil prices around the world since the conflict started or began. You can totally see that. Conflict began beginning of March, and that's when the spike in oil prices really kicked in. Our next chart shows the average price of a gallon of regular gasoline in the US is now above $4. Look at diesel. Wow. Diesel has really, really spiked. Gasoline prices, regular gasoline prices have spiked as well, but diesel is the one that has really spiked. And you can see the dotted line there, and that says Israel and the US begin joint strikes on Iran. So look at the spike in oil or gasoline at the pumps, directly related to the war in the Middle East. Next chart, one of my favorites, and probably my favorite for the show today, shows crude oil versus the S&P 500. And as I said right off the top, as goes oil, goes the markets. Oil comes down, markets go up, and vice versa. So what have we been seeing? WTI, which is or let's call it orange yellowish line. We've seen WTI moving higher. We've seen the stock market going lower. Sorry, my apologies. S&P 500 is the orange line. WTI is the blue line. We've seen a spike in the oil, which is the blue line, moving almost in a straight line higher. And then we see the S&P 500 coming down in lockstep. A clear relationship between the price of oil going higher and the S&P 500 going lower. And what a spike. Wow, WTI spiking significantly higher, bringing down the S&P 500 with it. Next chart shows what really everybody's keeping track of, which is passage through the Strait of Hormuz. Though I think it's about a 20-mile waterway. We spoke about it last show with our guest Ian Lee, and he was fortunate enough to be there. He says it's amazing to see this waterway, how narrow it is. You can literally see ships pass by your home or wherever you are, your business, and it's amazing to see all these tankers getting through. 20% of the world's oil flows through the Strait of Hormuz, and you can see here number of vessels going through at the end of February, 52. And now look how many are getting through throughout the month of March. 4, 2, 4, 5, obviously a lot less. And that is what's bringing up the price of energy, amongst other things. So definitely you want to keep an eye on oil prices. while you make or when you make your investment decisions. If you have a little bit of oil on in your portfolio, depending on what type of oil you have, you also want to be mindful because when the conflict comes to an end, or at least the market believes it's coming to an end, watch out because I think there'll be a significant pullback in the price of energy or oil. And what does that mean for oil stocks? Well, I think those will come down very quickly as well. So anybody sitting on oil stocks as an investment, be careful. Keep an eye on the headlines, keep an eye on what's going on, because we could see a significant decline in oil prices very quickly. Our next topic that I wanted to touch on, topic number 2, that you need to be mindful of when you make your investment decisions, is this idea of investing during uncertainty, volatility, ambiguity, whatever you want to call it, a whole bunch of names there. And as I said off the top of this segment, I look at it, investing at these times, the strategy, it's like investing, like playing a game of chess. You know, when the volatility is here, the uncertainty is here, just like a game of chess, you always want to make a few moves to set yourself up to either take an opponent's one of his pieces or to set yourself up to say checkmate, to win the game. But the moves you're going to make today probably won't show any positivity, probably for a few moves during the course of the game. So anybody who you're playing, if they're a good chess player, they're going to try and understand, oh, he's making these moves today to set himself up for what exactly. And that goes the same for the markets and your portfolio. I believe the investment decisions you make today, the good quality stocks that you buy today on the cheap, will set yourself up, just like in a game of chess, for success later on. You may not see the successes of the stuff you're going to buy today, but you will definitely see if they're good quality and if they are cheap. You definitely will see those moves pay off down the road, just like a game of chess. And I think it's a great analogy. For those of you that play chess, you know exactly what I mean. You want to buy good quality investments today that will pay off when this market turns around and there's a lot more calmness in the markets and things are going a lot better. Our first chart here shows the S&P 500 losing steam at times. And you can see here, there you have it. And it just goes to show you, COVID, then we saw the markets doing well. Then the Russia-Ukraine war, then the market's doing well. Another bit of a sell-off, market did well. You go all the way up to the U.S.-Israel-Iran conflict, and more than likely, you're going to see the market do well again. So again, buying in the difficult times, setting yourself up for when the market does a lot better. It gives us the opportunity to do better. And what areas of the market can you look at? Well, let's look at a few of them. iShares US Financials ETF, our next chart. Yes, financials, US financial companies, Citibanks, Wells Fargo, JP Morgan, Bank of America. Bank of America and JP Morgan, the two largest banks, are down probably the most out of the big banks. What other areas? Invesco QQQ, another ETF. And the Invesco QQQ, as all of you probably remember by now, we've had it on our show many times. These are your tech stocks. Look at the tech falling off, rebounding recently. You can see on the far right-hand side of that chart. A couple of stocks I wanted to highlight, which I've highlighted many times. Let's look at a chart of Microsoft, 6-month chart of Microsoft. Look at that sell-off. This stock at the high, $555. Look at it today, down roughly 30%. When have we seen Microsoft, arguably one of the largest companies in the world, one of the best businesses in the world today, down 30%? I call that, if you buy it, you're buying on sale. Another company that to take a look at, some of you may or may not be familiar with, is a company called Blackstone. We have a chart of Blackstone. And what you need to know is they are the largest asset manager in the world. They own real estate, all kinds of real estate. They create funds that people can invest in, private funds that people can invest in, put their money into, to own or to have ownership in buildings, in real estate, in different companies. They are the biggest asset manager in the world. Once upon a time, $190 a share. Today, it's back up to $115. As you can see on the chart, you could have bought it for just over $100 recently. And last but not least, Meta. Let's show a chart of Meta. I've talked about Meta a lot lately. Meta has been just in the doldrums, can't seem to gain any traction whatsoever. What is the high for this stock recently? $796. Today, under $600. Not sure where it's trading this morning. It was actually higher this morning. It was higher yesterday as well. So it's up a little bit from those lows. But Meta, another name, great name, one of the largest companies in the world. What do we, over 3 billion people in the world today are on Meta apps every day. Facebook, Instagram, WhatsApp, you name it. And the Meta glasses, which I have a pair of actually, and everything that they do. It's unbelievable to see a name like this on sale for as low as it is. So investing in during volatile times, you want a strategy. And the strategy, in my opinion, is buying good quality on the cheap while you can. Our third topic to be mindful of before you make your investment decisions is looking at economic data. And as I said, our first bit of data will come out on Friday. U.S. jobs. What are the jobs numbers going to look like in the U.S.? We have a chart of the recent months that have come out. And what a funny looking chart, I will say. It's unbelievable to think that from June of last year, jobs were down, July up, August down, September up. And we see this pattern of up, down, up, down. Unbelievable. February lost 92,000 jobs in the US. If we follow the pattern, maybe March will be an up number that is above zero. But obviously we don't know. So that's going to tell us a lot. We've seen a lot of weakness in jobs. I know the Fed has said they're not worried as much about that as they are inflation. Although recently Jerome Powell has said they're not so worried about inflation to get them to raise interest rates. We'll talk about that in a bit. But to me, I think jobs is a problem, especially with artificial intelligence and the disruptiveness of it. Our next chart here is Canadian employment, and that data is going to come out for our month of March. That's going to come out on April the 10th, so a week this Friday. And you can see the last 2 months have not been good for job creation or jobs growth. Next week, we're going to get PCE, our next chart. PCE now migrating in the US up to, let's call it 3%, well off the projection, or not the projection, but the expectation. The Fed would like to see inflation rates down at 2%. So I guess you could say 50% above target is where they're sitting right now. Next chart is CPI. CPI sits at around 2.5%. So some would say, well, what's the difference between the two? And the answer is real estate. CPI has a larger real estate component to it, whereas PCE does not. And we know real estate prices have been coming down in the US and in Canada for that matter. And so that has helped keep inflation down in Canada, but also keep CPI data down, or numbers down as well. So those are the three ideas I think individual investors need to be focusing on. You're looking at oil, you're looking at a strategy for investing during these times, and you're going to be mindful of the economic data that kicks off this Friday, because I think all three are very important before you make, or to look at these things before you make your investment decisions. As I mentioned off the top of the show, yes, oil has probably had the biggest impact on the markets in general, but there are a lot of other areas of the market that are being impacted by what's going on and not allowing tankers and ships to get through the Strait of Hormuz. Iran has basically said any ships that are going through that strait, that body of water, will have the potential of being blown up or targeted or set on fire, whatever they've said in the past 4 weeks. But other than oil, we've seen lots of other things affected by this, let's call it blockage or closing of the Strait of Hormuz. And we've seen things such as fertilizer, different chemicals, different chemical companies. And there we have a chart on fertilizer. And of course, helium, another thing that has been in the news most recently. But let's take a look at fertilizer first. Look at the fertilizer shipments have largely stopped since Iran conflict began. And there you have it. Look at the shipments going out, daily volume of fertilizer related to outbound shipments through the Strait of Hormuz. And now look at it since the Israel and US strikes on Iran. Basically, nothing is getting through the strait. Our next chart is one on urea prices. And urea fertilizer prices spiked since the Iran conflict. There you have the prices spiking unbelievably. And again, this has helped stocks like CF Industries, fertilizer company out of the US, Nutrien, which some of you that may own it here in Canada, Nutrien stock went as high as I think 115, 117 per share. And again, like oil, a lot of these stocks may pull back once the Strait of Hormuz is opened and shipments are allowed to get through. As I mentioned, another area of concern has been one of helium. Our next chart or comment shows helium and the effects of helium. About 1/3 of global helium supply moves through the strait all the time. And one is thinking, well, okay, so big deal. Helium, so you won't blow up any balloons. Not necessarily. It's an essential, it's an essential element for cooling and manufacturing semiconductor chips. I don't know if many of you knew this. So a shortage in helium can affect what's going on all over the world with semiconductor chips. And we know chips are needed for everything. And whether it's the devices, handheld devices, whether it's data center, AI, you name it, helium, very, very important. So not only is oil a worry for many investors, but you have other worries coming out of that region of the world, helium and different types of chemicals and fertilizer. And as we know, fertilizer affects food, right? Crops. If we don't have enough fertilizer in North America to grow crops, then food prices will eventually become affected. So very, very important to understand it's not just oil that is being affected by the conflict in the Middle East. It's many other things as well. What's happening with this group of magnificent stocks? What's happening with the Mag 7 themselves? Well, I guess to sum it up in one word, not good, or I guess that's two words, but they're going down. They've been going down for a little while now. These stocks have not been performing well. Perhaps they've become a victim of their own successes. Perhaps the bar has been set so high. Perhaps individual investors or too many individual investors own these names, and who's left to buy into them anymore? Everybody seems to, if you want these shares in your portfolio, you probably already own them. What's it going to take for more investors to get involved in these names? What's it going to take for investors to buy more of these names? These are all the questions that I think investors are asking, and why the group of seven has faltered as much as it has over the past year or so. Our first chart is the index itself, the CNBC Magnificent Seven Index. There you have it. And you can see probably reached a high somewhere around November of last year, and it has since pulled off. If you take each Magnificent Seven stock on its own, you'll see the performance. All Magnificent stocks are down double digits percentage from their 52-week highs, which is our next chart, which you will see. There you have it. Google's down almost 20%, Amazon 20%, Apple about 12.5%, Meta over 30%, Microsoft 34% from the high, NVIDIA down just under 20%, and Tesla down about 25%. Unbelievable. And look, you can see their 52-week highs, where they were, where these stocks closed at the end of March, or pretty much almost at the end of March. It's unbelievable that this darling group of stocks could falter as much as they have. I guess, as the saying goes, what goes up does come down. But I do believe that many of these, if not all of the group, is probably in a good position for individual investors to perhaps take a look at these names once again. Remember, buy low to sell high. We have another chart, chart of NVIDIA stock. There you have it, a year-to-date stock. So this would be about a 3-month stock chart, I should say, year-to-date chart. And you can see the volatility, and NVIDIA started to tail off just recently. Another Mag 7 name, Alphabet, or we know it as Google. Google stock really starting to fall off as well. For a while, Google was out of favor. Then with Gemini coming in, Gemini 3.0, rivaling OpenAI's ChatGPT. Alphabet became the darling very quickly, and has since lost a lot of its shine, and we've seen the stock pull back. So Mag 7, I think perhaps a good time to look at these stocks, especially if you want to buy good quality names on the cheap. Would you buy all of them? If you don't own them, definitely not. I think you want to take a look at each individual name on their own But I think once upon a time, they were very difficult to buy with a high bar set. Today, I think the bar has come way down. A lot of these stocks are trading at cheap multiples. And I think these are names that everybody, if you're looking for growth, can take a look at for your portfolio. Quick hits, three things that I've seen in the news recently that I wanted to comment on for all of you. Powell sees inflation outlook in check. That is Jerome Powell, the head of the Federal Reserve. No need to hike rates because of oil shock. So he's saying there is an oil shock, but he doesn't feel we need to hike rates as yet. He made those comments very recently. Bill Ackman, one of the best investors of our generation, in my opinion. He manages his own fund. He says it's one of the best times in a long time to buy quality stocks. And a lot of people do follow what Bill Ackman says. Development charges to be cut in half for 3 years through an $8.8 billion investment by Ontario and federal governments. Ontario especially and federal governments are trying to make building homes a lot cheaper. We're seeing the effects on our real estate market. We have an interesting chart coming up to show all of you exactly what's happening in the GTA or in Ontario. So let's go to our first quick hit. Powell sees inflation outlook in check. And he's saying basically in a recent interview that yes, inflation is ticking higher, but he thinks it's temporary. I guess if you probably asked him off camera, he'd probably tell you what I'm saying, that this war cannot last and probably will not last a whole lot longer. And so when the war is over, inflation will come down back to maybe 2.5% on the PCE, maybe closer to 2% on CPI. And then maybe the Fed will be focusing mainly on unemployment or jobs. And perhaps maybe that could mean maybe an interest rate decrease later this year. I know the markets are right now pricing an interest rate increase in the US, but I don't believe that's going to happen. Our first chart and only chart, or one of the charts for this segment, is about interest rates. You can see it there, target range for federal funds rate. You can see it's been coming down and it's remained flat in the last few meetings. There, the S&P 500, we have a chart for that index, which is a 1-month index, and you can see a bit of a spike up because I think everyone's starting to anticipate that perhaps maybe, just maybe, this war isn't going to last as long as we thought or we feared. Our next quick hit is Bill Ackman saying it's one of the best times to invest. Patty Lovett-Reed in our interview thinks it's a great time to invest. I think it's a great time to invest. Obviously, if you can handle the volatility that investing during these times bring, if you can handle or have the iron stomach that it takes to get into an investment idea, as I said, like playing chess, you're buying today for later on down the road to win, as we do in chess, or to at least win in the stock market and see the results later on. So I think it's a good time, and so does Bill Ackman. The one comment we have from Bill, we can pull it up. Some of the highest quality businesses in the world are trading at extremely cheap prices. One of the most one-sided wars in history that will end well for the US and the world, and we have the potential for a large peace dividend. One of the best times in a long time to buy quality. Ignore the bears, ignore the negative speak, ignore the negative people. Those people, he's saying, are not worth focusing on. Our third and final quick hit is the idea of the government spending money to reduce development charges, cutting them in half so that more homes can be built. We can see the housing industry get back up to speed. You know, we keep hearing time and time again, housing market in Canada and the US for that matter is a bit under the gun. And our first chart, or only chart for this segment, actually shows this. In Ontario, markets are weakest in the GTA and surrounding areas. Look at the GTA. These are sales to new listings ratio. It's the highest in Northern Ontario, Eastern Ontario, and the lowest in the GTA and GTA commuter belt. And as the writing underneath, if some of you can't see it, that includes places like Barrie, Brantford, Guelph, Hamilton, Orillia, etc. But look at GTA. Obviously, in my opinion, a function of pricing, a function of the pricing of homes. So 3 quick hits that I wanted to touch on, give you my opinions on, and there'll be obviously many more headlines coming out in the next couple of weeks, and we will bring you those at our next show. what's my take? This is part of the show where I take at least one question from the audience, and I can't help but to take. I have a bunch of questions here, but the first one on the list is a question I think everyone could be asking, and I've been getting not as much as I've received in the past during volatile times, but one I'm starting to get more and more of as the war drags on. Market volatility from the war is keeping me up at night. Should I move my investments into cash so I can sleep at night better? It is the question I think that is more and more on the minds of investors. I think my show today clearly says where I'm at, where Patty Levitt-Reed is at, where Bill Ackman is at. The answer is no. You shouldn't try and time the markets. If you're getting or moving into cash, it's because you're going to stay there and you need the money to do something with. But if you're moving to cash to get back into this market at a later date, it's because you're trying to time the market, and timing the markets never works out. Some investors get lucky every now and again, but for the most part, when you get out to get back in at a later date, it just never works out. So with that, I want to say thank you to all of you that took the time to tune into our show today. Hopefully all of you picked up something from our show, whether it was the interview with Patty, whether it was all the other information we brought to you today. Hopefully you'll come away from this show a little bit knowledgeable, a little bit more knowledgeable about what's going on and the effects on the markets. I want to say I hope all of you tune in 2 weeks from today, 12 noon across all social media platforms, or go into allansmall.com, click on the button. It'll take you right into YouTube where you can watch our next show. On our next show, we will have Jack Mintz, formerly of the C.D. Howe Institute. He'll be coming on to discuss taxes and the need for Canada to look at our tax system and the need perhaps for tax reform. A great show, a topic, as all of you know, that is near and dear to me. So until that time, until that great show that we will have for you in 2 weeks, happy investing.